You finally did it. You signed the papers for the forever home in that perfect, top-rated school district. You have the keys in your hand, the extra square footage you've been dreaming about, and the prestige of that nice suburban zip code. But as you unlock that heavy, custom front door for the first time, you don't realize you just traded your actual financial freedom for a $5,500 monthly mortgage. It's 2026. You're making great money, probably more than you ever thought you would, but you are about to step into the most common wealth trap of the middle class. Because the cost of this upgrade isn't just the sticker price of the house. It's the silent, invisible math that is going to bleed your cash flow dry over the next 5 years. Level 1. The honeymoon phase. The first year feels like total victory. You moved from a cramped 1,500 square foot starter home that you bought years ago with a golden 2.9% interest rate. Back then, your mortgage was a breeze, maybe $1,800 a month. But you felt stuck. You had kids, you worked from home, and scrolling Zillow became your nightly toxic habit. So, you pulled the equity out, stomached the 2026 interest rates hovering around 6.8%, and bought a $750,000 four-bedroom house. When Thanksgiving rolls around, you host. The extended family gathers around your massive quartz kitchen island. Everyone tells you how beautiful the space is. You feel like you've genuinely made it. You justify the massive jump in your monthly payment by telling yourself the classic lie. Real estate is the best investment, and we needed the space for the kids. Then there's your former coworker, Sarah. Sarah makes the exact same salary as you. She's also married, also has 2 kids. But Sarah decided to stay in her tiny 1,500 square foot house. She's still sharing a single bathroom with her toddlers. When you invited her to your housewarming party, you caught her looking at your vaulted ceilings with a flash of envy. You felt a little bad for her. You shouldn't have. Level 2. The invisible bleed. Year 2 is when the cracks start to appear. It doesn't happen with an explosion. It happens quietly, in the mail. First, the county reassesses your property value. Because you bought in 2026 at a premium, your property taxes suddenly catch up to the purchase price. You get a letter from your mortgage servicer about an escrow shortage. Your $5,500 monthly payment quietly creeps up to $6,100 to cover the difference. Then comes the homeowner's insurance renewal. You open the notice to find your premium has jumped by 40%, a direct hit from the 2026 insurance market, where carriers are pulling out of states and rates are skyrocketing. On top of that, your new neighborhood has an HOA. It's not just the $200 a month, it's the special assessment they just passed to repave the community pool, adding another $1,500 out of pocket this year. You're making $220,000 a year as a household, but suddenly, after taxes, maxing out the 401k to get the employer match, paying for childcare, and covering this colossal housing expense, there is nothing left. You stop going to the nice dinners. You delay the family vacation. You tell yourself it's just a tight month, but the tight month becomes a tight year. Level 3. The 2 a.m. math. By year 3, the illusion completely fades. It's a Tuesday in late November. The first real freeze of the year hits, and your 15-year-old HVAC unit completely dies. The repair guy quotes you $14,000 to replace the dual-zone system this massive house requires. It's 2 a.m. You are sitting at that beautiful quartz kitchen island you were so proud of. The house is freezing. You open your Chase banking app. You have $4,000 in your checking account and maybe $8,000 in a high-yield savings account that was supposed to be your 6-month emergency fund. To fix the heat, you are going to have to put it on a credit card at 24% interest or borrow against your 401k. In the quiet of the night, the crushing weight of the house finally hits you. You are house poor. You own a gorgeous structure, but you have zero liquidity. You realize that you go to work every single day, deal with a boss you tolerate, endure the stress and the commute, entirely to feed the beast that is this house. The house owns you. Level 4. The Parallel Universe. 5 years later, the real math is impossible to ignore. Over these 5 years, your house might have appreciated. Let's say your $750,000 house is now worth $850,000. You feel like you made $100,000, but did you? Over 60 months, you paid a 6.8% interest rate on a massive loan. You dumped roughly $200,000 purely into interest to the bank. You paid $60,000 in property taxes. You spent $30,000 on maintenance, including that HVAC system, and constant landscaping for the bigger yard. Your equity is an illusion funded by massive, unrecoverable costs. And what about Sarah, the coworker who stayed in her cramped starter home? By keeping her 2.9% rate and her $1,800 payment, her housing costs were roughly $4,000 less per month than yours. But Sarah didn't spend that money on cars or vacations. She automated it. Every single month, $3,000 was auto-drafted into a low-cost S&P 500 index fund. While you were paying interest to the bank, Sarah was earning compound interest. With the market doing its thing, over 60 months, those $3,000 monthly investments, compounding quietly in the background, have snowballed into nearly $220,000 in liquid, accessible index funds. She still has her starter home equity, but more importantly, she has $250,000 in liquid wealth. If Sarah loses her job tomorrow, she is fine. If you lose your job tomorrow, you're 90 days away from losing the house. Level 5. The Fortress. The hardest truth about building wealth isn't about knowing how to pick stocks or time the market. It's about fighting the psychological urge to look wealthy before you actually are wealthy. When you look back at that 1,500 square foot house with the 2.9% interest rate, you realize something profound. It wasn't a starter home. It wasn't a prison holding you back from your dream lifestyle. It was a fortress. It was a financial moat that protected you from inflation, gave you maximum cash flow, and offered the ultimate luxury: the ability to sleep soundly at night knowing you have options. True wealth isn't the vaulted ceilings or the extra bedroom that stays empty most of the year. True wealth is liquidity. It's the gap between your ego and your income. And sometimes, the richest thing you can do is stay exactly where you are.